Usually, like when we talk about a medical diagnosis, there's this expectation of clinical precision.
Right, yeah, like it's black and white.
Exactly. You break your arm, the x-ray shows that jagged white line, and the doctor just points at it and says, there it is, broken.
It's visible, it's categorized.
Yeah.
And, well, I mean, that binary nature is incredibly comforting when you're looking for a solution. You know what you're dealing with.
But then you step into the world of complex business operations, specifically the business of putting things back together after a massive disaster.
Oh, man. Yeah.
I mean, think commercial fires, flooded high-rises, hurricane recovery. In that restoration industry, the X-ray machine is completely broken.
It doesn't even exist, honestly.
Right. We are looking at a diagnostic landscape that is just incredibly murky. And that brings us to the core premise we're unpacking today for our deep dive. We're looking at notes and excerpts from a really fascinating piece called The Future of Restoration by Jeff Magoon.
Yeah, that's a brilliant piece.
It really is. And the mission for this session is to explore this massive hook he presents, which is that the companies that are going to win the next decade in the restoration industry, they're not the ones who are simply the best at fixing buildings.
Which, I mean, sounds completely counterintuitive on the surface, right?
Yeah, totally.
You naturally assume the highest quality builder, the one with the best craftsmanship, is going to dominate the market.
Of course. That's what you're hiring them for.
Right. But the reality on the ground is shifting drastically. The ultimate winners are the companies that are morphing into sophisticated risk management organizations.
Which is wild.
It is. And this is exactly why you, listening right now, should care about this deep dive.
Yeah.
I mean, even if you have absolutely nothing to do with property restoration, these concepts offer, like, a masterclass in business survival.
Totally applicable anywhere.
Exactly. It's a blueprint for shifting from a purely reactive firefighting mindset,
Which is exhausting.
right, into a proactive value-building strategy. It proves that mastering your actual craft is really only half the battle.
Yeah.
The other half is mastering the volatile environment your craft exists within.
Mastering the environment. I love that framework because, well, to understand where we are going, we have to look at what that environment used to be.
Right, the old days.
The old days. For decades, the entire view of risk and insurance in this industry, and honestly, across most small, medium businesses, was incredibly transactional. It was this annual renewal mindset.
The set it and forget it mentality.
Yes.
Historically, business owners viewed insurance primarily as a fixed cost.
Yeah.
It was just another annoying line item on the P&L.
Just the cost of doing business.
Exactly. And the cycle was entirely predictable. Once a year, the renewal date arrives, the premiums inevitably increase.
As they do.
Right? The owner grumbles about the cost, the broker haggles the coverage down to something financially manageable, everyone signs the paperwork.
And then you just put it in a drawer.
Yeah. The entire concept of risk is completely ignored until a disaster happens and someone actually needs to file a claim.
But that model is dead on arrival today. It just doesn't work.
No, not at all.
Because the restoration business now operates in one of the most complicated environments imaginable. Just think about the sheer volume of variables involved in a single mid-sized commercial restoration project.
It's staggering.
It is. You aren't just swinging hammers. You are coordinating with, aggressive general contractors. You've got anxious property managers breathing down your neck.
Oh, and the insurance carriers.
Yes, multiple insurance carriers who all have competing interests. You have complex municipal zoning laws. You have strict environmental regulations regarding hazardous material disposal.
And you're navigating OSHA regulations on top of all that.
Right.
You're ensuring every single worker on that chaotic, partially destroyed site is adhering to federal safety standards. And, I mean, if an OSHA inspector walks onto a messy water damage site and finds a single extension cord sitting in a puddle,
it's game over.
The fines can be absolutely crippling.
And that's just the physical on-site reality. We haven't even talked about the modern business complexities.
Right, the digital side.
Cybersecurity threats, crushing labor shortages where you
Right.
literally can't find skilled technicians, the logistics of equipment financing, managing a massive fleet of vehicles.
It is a staggering web of potential failure points.
It really is. Okay, let's unpack this. Treating risk management as just an annual insurance purchase is like treating a yearly trip to the dentist as your entire health strategy.
Well, that's a good way to look at it.
Right. Like completely ignoring daily brushing and diet.
Yeah,
You just eat candy all year, never brush your teeth, and then you're furious that the dentist is charging you triple for an emergency root canal.
exactly.
The financial pain didn't happen in the dentist's chair. It happened in the 364 days you spent entirely neglecting your daily hygiene.
That is the perfect way to visualize it. Well, in business, your hygiene is your safety protocols, your contract reviews, your daily operational discipline. If you're only looking at your risks once a year at renewal time, the structural decay has already happened. What's fascinating here is the complete paradigm shift required to survive.
Yeah, tell me about that.
The organizations that are actually thriving have internalized a fundamental truth. Insurance isn't the strategy.
Okay.
Insurance supports the strategy. Active daily risk management is the strategy.
Wow. That distinction changes everything, doesn't it?
It really does.
It's not about which policy you buy. It's about how you operate your company every single hour of the day so that you rarely have to use that policy.
Exactly.
But I want to dig into the timing of this because, why is this happening right now? Why can't an independent, family-owned restoration company just roll up their sleeves, put in more hours on the job site, and just work harder to overcome these modern complexities?
Right, the sweat equity approach.
Yeah. Why is sweat equity no longer enough?
Because sweat equity does not solve systemic market shifts. You can't outhammer a macroeconomic trend. We're seeing three massive industry forces that are entirely reshaping the landscape. And, well, they require strategic intelligence, not just more elbow grease.
Okay, what's the first force?
The first overwhelming force is rapid consolidation driven by private equity.
Right. Private equity firms are rolling up local and regional restoration shops at an unprecedented rate.
They are, and this fundamentally alters local market dynamics. I mean, think about it. When an independent shop is bidding on a major contract, say, like a long-term emergency response agreement for a regional hospital system,
A huge deal.
a massive deal, they are no longer competing against the other local family-owned business down the street.
The landscape changed.
They're competing against a newly formed private equity-backed behemoth. These consolidated organizations have immense centralized buying power. They have enterprise-grade human resources departments to attract top talent. They have in-house legal counsel.
Which means when the hospital asks for a 50-page packet detailing the vendor's compliance protocols, the PE-backed firm generates it instantly,
Exactly.
while the independent shop is struggling to put together a PDF after a 14-hour shift on a site.
Exactly. The dynamic.
Huh.
You cannot outwork a corporate legal and finance team.
No.
You have to outsmart them by institutionalizing your own operations.
Okay, let's move to the second massive force changing the landscape, which revolves around the insurance carriers themselves. Oh, wait, hang on. I want to push back on this a bit.
Sure, go for it.
If I run a business and I haven't crashed a company van in 5 years and I haven't had a single workplace injury, why does the carrier care if I have a formalized digital safety program? Doesn't my clean historical record just speak for itself?
That assumption is the exact trap that catches so many veteran business owners off guard.
Really?
Yes. Relying solely on loss history is obsolete thinking, according to the source. Carriers today are fundamentally changing their expectations. They are just betting on your past luck.
Oh, I see.
They are actively auditing your current operational competence. They want to look under the hood to see how you achieve your results.
So they're looking for the mechanisms of safety, not just the absence of accidents.
Yes, exactly. For example, carriers are now demanding to see your fleet telematics.
Wow.
They want to know if you've plugged diagnostic tracking devices into your vans to monitor harsh braking, speeding, and aggressive cornering in real time.
That is invasive, but it makes sense from a risk perspective.
Totally. They also want to review your cybersecurity protocols. Because a restoration company holds personally identifiable information, blueprints of commercial buildings, sensitive financial data.
A lot of leverage for a hacker.
A ton. If a ransomware attack encrypts your scheduling software, you suddenly have 50 trucks sitting idle because no one knows where to go.
Oh, man, yeah.
That is a massive operational risk that carriers want mitigated. They're auditing your AI usage, your financial controls, your employee training.
And the underlying logic here is pure causality, right? Better operators, meaning those who actively manage these operational details and can prove it with data, they present a tangibly lower overall risk to the carrier.
Right. And because they present a lower risk, they secure better insurance outcomes, better rates, and better coverage.
which cascades into a massive competitive advantage.
Huge.
If your insurance costs are 20% lower than your competitors because you run a tighter ship, you
Oh,
can outbid them on jobs and still maintain a healthier profit margin.
exactly. Which brings us to the third pressure forcing this evolution. And honestly, it might be the most relatable one for our listeners.
Okay.
Customer expectations.
Oh, yeah. We've all been trained by the digital economy.
We have. The end client today expects a restoration company to act like a Silicon Valley tech company.
It's true. If a homeowner or a property manager has a flooded building, they are not going to tolerate a paper invoice mailed 3 weeks after the job is done.
Not a chance. They want the Amazon-level experience. They expect immediate multi-channel communication. They demand digital documentation.
Like daily photo updates of the drying progress.
Yes, online approvals for change orders, and absolute transparency from start to finish.
And if a company lacks the operational maturity to provide that seamless digital experience, they aren't just annoying the customer, they're actually presenting a risk to that customer's peace of mind,
Right.
which translates to delayed payments, negative reviews, and a damaged reputation.
Exactly. When you combine these three immense pressures, private equity consolidation raising the operational bar, carriers demanding proof of competence, and customers expecting tech company-level service, you realize that the traditional reactive approach to business isn't just outdated.
It's actively dangerous.
It is actively dangerous.
Which brings us to a pretty harsh reality check. Given all this complexity, what is the single biggest mistake a business owner can make?
Oh, this one is so common.
It's sitting back, throwing their hands up and saying, my insurance agent handles my insurance.
That is a complete abdication of executive responsibility.
Yeah.
Relying solely on a traditional agent who just shops for quotes once a year is only addressing a tiny fraction of the actual threat landscape.
Right. This is where the source introduces a fascinating evolution of the role. The insurance intelligence partner.
I love that term.
It's great. Instead of treating risk as a transaction, this partner acts as a strategic advisor. Instead of sitting down at renewal and asking the basic question, why did my premium go up? Leaders need to be asking forward-looking, existential questions.
Questions that actually dictate the survival of the enterprise. Like, are we even going to be an insurable entity in 5 years based on our current operational trajectory?
Wow, yeah.
How do potential buyers or investors evaluate our risk history? Which specific hidden operational risks threaten our overall valuation?
There are some incredibly hard, specific business questions you have to wrestle with here. And as you listen, try to map these onto your own industry, right?
Yeah, totally.
For instance, are your subcontractors transferring enough risk? If you hire a third-party plumber for a project and they accidentally flood a 10-story hotel, whose insurance is paying for that catastrophic loss? Yours or theirs?
That is a terrifying question if you don't know the answer.
Right?
Or consider revenue concentration. Would your company survive financially if you lost your single largest customer tomorrow?
Another great point.
That's a massive risk that has nothing to do with physical safety, but everything to do with business continuity. Or what about your contracts? Are the agreements you were signing with property managers inadvertently increasing your liability without you even realizing it?
And wait, if we connect this to the bigger picture, it becomes painfully obvious that these are not insurance questions.
No, not at all.
These are fundamental business architecture questions. When an owner stops saying, my agent handles that, and starts aggressively wrestling with these structural vulnerabilities, the entire trajectory of the business pivots.
Because answering these hard questions reveals a really surprising truth. Risk management isn't just about building a defensive moat to protect the castle.
Yep.
It's actually a hidden profit center.
Profit center.
Yes, it is the most overlooked profit center in modern business.
Okay, walk me through that.
There's a golden rule at play here, according to Magoon. Every dollar not lost becomes profit.
Oh, wow.
It is a one-to-one direct translation to your bottom line. Let's look at the mechanics of this, starting with fleet management. If you manage your fleet proactively using the telematics we discussed, you create a feedback loop.
Okay.
A manager gets an alert about a driver's harsh braking. They have a 5-minute coaching session the next morning, and an accident is prevented before it ever happens.
And the financial ripple effect of preventing that one accident is just huge.
Massive.
You have 0 deductibles paid out of pocket. You have 0 vehicle downtime, which means your crews are actually out in the field working and billing revenue instead of sitting in the shop waiting for repairs. It even boosts morale because nobody wants to drive for a company that ignores safety.
We see the same profit generation in contract reviews. Let's talk about indemnification clauses.
Okay.
An indemnification clause is essentially the legal language that dictates who is financially responsible if things go sideways on a project. If you sign a contract with a poorly written indemnification clause, you might accidentally agree to cover damages caused by someone else entirely.
Which is a nightmare.
A literal nightmare. Finding and negotiating that single clause before you sign the document isn't just an administrative chore.
Right.
It is literally saving hundreds of thousands of dollars in potential liability. It is defensive profit generation.
Here's where it gets really interesting, though, because the natural pushback from any busy professional is, I don't have time for this.
Oh, I hear that all the time.
How do I actually execute all of this? How do I monitor the fleet, coach the safety behaviors, review the dense legal contracts, and update the clients, all without grinding my actual daily operations to a complete halt?
It sounds impossible.
Right. The answer is technology. But not just basic accounting software. Technology is evolving into the ultimate automated risk management tool.
The technological stack available now is breathtaking in its ability to mitigate risk mechanically. We're talking about AI-driven documentation, drone inspections, Internet of Things, moisture monitoring, automated scheduling algorithms, predictive maintenance, CRM automation.
Let's dive into how some of these actually work because the mechanics are brilliant.
Yeah, let's do it.
Take moisture monitoring. In the old days, if you were drying out a flooded commercial building, a technician had to physically drive a truck 45 minutes across town every single day just to check if the fans were working and to take manual moisture readings.
It was wildly inefficient.
So inefficient. Today, companies use Bluetooth-enabled moisture sensors. They place them in the wet drywall, and those sensors beam real-time drying data directly to a cloud dashboard.
And think about the risk mitigation there. If a machine fails in the middle of the night, the project manager gets an alert instantly. They fix it before mold has a chance to grow. If a client comes back a year later and claims you didn't dry the property properly and tries to sue for secondary mold damage, you don't just have a technician's handwritten smudged notes to defend yourself.
Right.
You have an immutable, time-stamped digital paper trail of the exact moisture levels dropping day by day.
Yep.
You've neutralized the liability entirely.
Or take drone inspections. Instead of putting a human being on a steep, slippery, 3-story roof to check for storm damage, which is a massive workers' compensation risk,
Huge risk.
you fly a drone.
Yeah.
The AI analyzes the high-resolution photos, it identifies the pre-existing damage, and it creates a perfectly documented baseline before your crew ever steps foot on the property.
It's brilliant. And it also brings up the concept of digital standard operating procedures, or SOPs.
Right, SOPs.
When you digitize your workflows, you ensure that every single technician, whether they've been with you for 10 years or 10 days, follows the exact same safety and operational steps on every single job.
Consistency destroys risk.
Yes. But there is a vital distinction to make here regarding this technology boom. Technology is not replacing the restoration professionals.
Right. AI isn't ripping out wet carpet,
Yeah.
and robots aren't installing new drywall.
Precisely the opposite. The technology empowers the human professionals. By offloading the administrative burden, automating the scheduling, and providing real-time data, these tools allow the professionals to make fewer mistakes, focus deeply on their actual craftsmanship, and ultimately deliver that superior, transparent client experience we discussed earlier.
So when an organization puts all this together, when they combine this relentless, profit-driven risk management mindset with advanced technology enablement, they achieve the ultimate business goal.
Yeah.
They build massive enterprise value.
And enterprise value is the holy grail.
It really is.
But founders and operators frequently underestimate how their approach to insurance and risk directly dictates that valuation number. Because, well, they still view it through that outdated lens of an annual annoying expense.
But when potential buyers like those private equity firms driving the industry consolidation we talked about, when they come in to evaluate a company for an acquisition, they are looking under every single operational rock.
Oh, yeah. They do a forensic level of due diligence.
Forensics is the right word.
They scrutinize your claims history, your safety metrics, and your employee turnover. They analyze any pending litigation. They audit your subcontractor agreements, your fleet performance, your HR compliance, your cybersecurity defenses, and your digital workflows.
Everything.
Everything. They want to know exactly what kind of structural integrity they are buying.
And strong, documented risk management creates absolute confidence for that buyer. Confidence mitigates the buyer's risk, and less risk translates to significantly higher valuations.
Exactly.
The core lesson here is that enterprise value is not created at the negotiating table.
No, it's not.
It is built years before a business is ever sold. It's built in the daily operational discipline, in the digital SOPs, and in the proactive safety culture.
It requires an evolution in leadership.
Hmm.
You have to transition from working in the business, putting out daily fires, to working on the business as an architect of resilience.
So what does this all mean? Jeff Magoon's philosophy really synthesizes this entire journey.
It does.
True leadership in this space means rejecting the idea that insurance is a yearly transaction. It must be integrated into the DNA of the business strategy.
Right.
This mindset bleeds into your daily operations, your brand reputation, your technology stack, your organizational structure, and how you deploy fractional leadership to help you scale.
It changes everything.
It really does. The ultimate mission is to scale intelligently, which requires leaders to stop thinking like contractors and start thinking like strategic CEOs. To briefly recap the key takeaways for you listening, your insurance program should dynamically support your business strategy, not just passively protect it. Active risk management isn't a chore. It is a measurable competitive advantage that generates profit. By leveraging technology and digital workflows, you radically improve your operational resilience. And finally, better operators simply experience better outcomes across the board.
This raises an important question, though.
Oh, I like where this is going.
I want to build on this concept of enterprise value being constructed long before a sale, but I want to apply it directly to you, the listener.
Okay.
Think about your own professional life, your career trajectory, or the specific department you are running right now. If an outside investor were to come in today and brutally evaluate your personal enterprise value, what hidden risks are they going to find?
Oof, it's a tough question.
It is. What talent gaps, technology blind spots, or operational bottlenecks are you currently waving away as just a cost of doing business?
Right.
Are you just waiting for your own version of an annual renewal to magically fix things? Or are you actively managing those risks today to build unshakable confidence in your future?
That is a phenomenal question to leave off on. We often spend so much time obsessing over our core craft that we completely forget to manage the risks surrounding it.
So true.
Remember, the next time you're looking for that clean binary X-ray to solve a complex problem, whether you are fixing a broken supply chain, rebuilding a flooded hospital, or designing your career, the real value isn't just in knowing how to fix the break.
Right.
The real value is in building a system so incredibly resilient that the break never happens in the first place.
Absolutely.
Thank you so much for joining us on this deep dive. We'll catch you on the next one.